combine bits and pieces of each one of these types of programs. So let's talk about the plans. There's something called a money purchase pension plan. This is an employer contribution. It's either a percentage or a flat amount that they deposit every year. The most they can put into an account is 100% of income, or a maximum of $50,000. The gains and losses are allocated to participants. What happens should a company, again, you're vested, right, or you're in a vesting mode, and you leave and there's money out there in your account that the company has placed in there, but yet it's not vested, and when you leave, it now goes back to the company. What can they do with that money? So the forfeitures, in this case, is what that's referred to, says that they can either be reallocated, so we can then distribute them to the remaining employees, or the company can retain them and reduce future payments by the company. And of course, how this gets invested is determined by the trustee of the plan. So there's no employee contribution here. It's only the employer contribution. A simple retirement plan is for companies that have 100 or fewer employees. Works a lot like a 401k plan. The maximum amount's $12,000 in 2013. And there are really no discrimination rules if the employer matches up to 3%, or if they automatically just put in 2%, not counting an employee contribution. So if the employer says we'll match up to 3%, they don't have to worry about following any discrimination rules. If they don't want to put in 3% and they're worried about discrimination rules, they still have to put in 2% anyhow. So you could put 0 in, they put in 2%, non-discrimination rules are now in place. A SEP plan works a lot like IRAs. In fact, the contributions are into mutual funds that are actually IRA vehicles. There's not a lot of paperwork. Again, the maximum is $51,000 or 25% of income, whichever one of those is lower. And again, the IRA rules are followed except for the contribution limits. So obviously the IRA rules are, you can't take your money out till you're 59 and a half, etc., etc. The thing that's different here is the amount of contribution. Again, you could have a SEP plan and still have individual IRAs outside of the work plan. So you could put $15,000 here, and you could put $5,000 into an IRA, and that would be fine, even though they're all into IRA plans or programs. A profit sharing plan uses some kind of a formula, right? You can still make contributions even if there's no profit, because it's a formula. Maybe it's based on sales, or it's based on some other accounting number, if you will. The amounts are limited though. You can't pay more than 25% of the compensation to all eligible employees. So you find out what total compensation is. The most you can distribute is 25%. Vesting rules here, they apply. Kind of like we talked about a little bit earlier. If there's a forfeiture, they can either reduce future contributions or they can split that amongst remaining employees. 401k plans is what most people in bigger companies are involved with. Essentially, this has company and employee contributions. The most you can do right now is $17,500 is the employee contribution. Again, if you're over 50, you could add another $5,500 to that. The company can then also match, but the total combined contribution can't exceed $45,000. Individual 401ks are possible if you're self-employed and you don't have employees. So you can get a 401k type of instrument, right, with these larger contribution rules, even if you're self-employed. But if you have employees, you can't have an individual 401k. 403bs are very similar, except they're for a nonprofit company. So it's open to the 501c kinds of companies. much limited, the same as a 401k is. It's a lot like a 401k. Again, the difference is typically is the, just the difference in the kind of company that it comes from. There are other kinds of programs, stock bonus plans, thrift plans that are combinations of profit sharing and stock bonus plans. And ESOP is a company, it's an employee stock option plan, where essentially you invest primarily in company stock is what the retirement program is invested in. Defined benefit plans are totally different. Again, the company makes contributions. What you get out of this is dependent on your salary, right? So it could be fixed benefit plans where all employees get the same kind of benefit. It could be a flat benefit plan where the benefit is a percentage of your salary. Unit benefit plans. There are a variety of methods of how the company ultimately distributes this money. Again, the difference here is, you know, in quotes, you know what you're going to get when you leave. If it's a flat benefit plan, it's dependent on your salary, but once you get to retirement, you know what your benefit will be from there on. The company, though, makes all the contributions. So you don't know what goes in, you only know, in quotes, what comes out. There are age-weighted profit-sharing plans. Again, one of the things, especially for smaller businesses, is that the owners of small businesses want to retire. Well, in most businesses, the oldest people in the company are the owners. So they want to find a way, how can I as the owner get more distribution to my retirement account so I can retire the way I want to? Not that I want to screw over my employees, I want to give them a benefit, but since I'm the owner, I want the biggest benefit. The challenge with that is it sometimes will not meet the discrimination rules. We won't be able to follow exactly the percentages that are stated in profit-sharing plans. So again, these age-weighted things, the maximum deduction, again, is 25% of covered payroll. Each year, the employer maintains discretion over making contributions to the plan. They can make them or not make them. Again, there's some uncertainty here. Top-heavy plans, if a lot of money is going to those highly compensated individuals, we may have to satisfy a top-heavy minimum requirement, so that there may be a minimum distribution that's required to all employees, right? And again, forfeitures are allowed to be reallocated, etc. So how does this ultimately work? Well, here is a plan. Here's the company, right? There's $350,000 worth of compensation, and under the traditional plan, they were paying everybody 10%. So the total plan distributed $35,000. Everybody got 10% of their income. However, the owner wants to do this so that they get a little bit more. So if they do an age-weighted plan, as you can see here, the owner, since they're older, they get a much higher distribution, certainly a much higher distribution than this employee down here that's 20 years old, only got $750 contributed that year. Again, it's not that we don't want to give our employees anything, but we're in business to obviously gain wealth and ultimately retire ourselves, and this is just a way that helps benefit the owners of a company, especially those that may be older. We talked a little bit about, how do you get your money out of a plan, right? You can leave your money in the former employee's plan. Most employers don't want you to do that. They want you to take it out. You can either move it to the new company's plan or you can move it to an IRA, but they would like you to move it whenever you can. You could take the cash. Of course, you're going to get a reduction if you're younger than 59 and a half. There could be a 10% penalty if you don't get the correct amount moved in. You could start periodic withdrawals, but again, if you're younger than 59 and a half, you're going to pay a 10% penalty. You could take the cash and put it into an IRA. Again, there are special rules in this type of a transaction. Quite frankly, I don't think that any of these, that the second, third, and fourth rules here make sense for anybody because of penalties. You either have to leave the money in there and then ultimately roll it over into another account. I mean, that's really your two choices if you're under 59.5. So again, move it to an IRA or move it to some type of another qualified plan. Could be a variable annuity that we talked about. So there's places to move this so you avoid taxation and you avoid penalties. An IRA account, we're going to talk a little bit about this just over the last couple of slides. Most of us are familiar with this. Essentially, I want to talk about some of the things that we don't think about all the time. There are really two kinds of IRAs, a traditional or a regular IRA and a Roth IRA. The difference between the two is taxation. In a regular IRA, you get a tax deduction today. You get to write off your contribution into the IRA today. When you take the money out at retirement, all the money that was contributed, including all of the growth, is taxed. In a Roth IRA, you don't get a tax deduction today. So the money that goes into a Roth IRA is after tax. You've already paid taxes on the contribution. The difference now is when you get to retirement, the contribution, since you've already paid taxes, will come out without taxation. But also all of the growth comes out after tax or without taxation. So there is to me, I think is if you're a young person, the benefit to a Roth IRA is when you get to retirement, you're going to have income that avoids taxation, right? There's no tax once you start withdrawing this. The types of IRAs, you could do an individual retirement plan. You could do an individual retirement annuity plan. I mean, both of those are basically the same types of vehicles with just different types of providers. An individual retirement plan would be marketed by brokerage houses, etc. But an individual retirement annuity plan is typically going to be brokered or marketed by more like an insurance company. So, what does deductible versus non-deductible mean? We've talked about this. Either you pay taxes now or you don't pay taxes now. Still, the maximum contribution is $5,500 or your gross income, right? Again, if you're over 50, you can put in an extra $1,000. But you can't put anything more in there, even if it's non-deductible. $5,500 is the maximum contribution. We talked about traditional and Roth IRAs. We've also talked a little bit about rolling over versus transfer, right? Converting an account, such a 401k, from a previous employee, technically is a rollover, right? If the roll is technically a rollover if it goes through the investor, right? So if you get the check and then you deposit it, that's considered a rollover. A transfer is a more prudent method. It goes kind of through the air and ultimately ends up at the new account, if you will. And actually, transfers, like it says here, are probably the easiest and best ways to do it. So now you don't have to worry about any kind of taxation or penalty issues. We talk a little bit about deductibility, right? How this ultimately works. It's also based on your income, right? So if you're participating in a pension plan, right? If you have a joint account, right? If you're $5,000 beginning in 2007, again, these incomes they're adjusted for inflation, etc., right? Your modified income will tell you how much can ultimately be deposited. The more money you make, the less of the, in this case, $5,000 can ultimately be input into the program. If you have a job that has a plan, then there is a reduction in how much can ultimately be input into a program if you want to deposit money into an IRA. So again, there's some special rules depending on income and whether or not you have a job or you don't have a job. And the last slide here, again, your book has this in there and talks about the difference. Says, look, you know, if you put your money in before tax and it grows, you know, when you're 30, you're going to have $611,000 is the tax that you ultimately have. If it's an IRA that's after tax, like a Roth IRA, it says when you get there, you're only going to have really $440,000. That really is not true. You still put the same amount in. You're going to put $5,000 in, whether it's before tax or after tax. You input $5,000. What they're talking about is an opportunity cost. If you put money in before tax and you get that tax deduction, what can you do with the taxes that you save? Well, obviously you could invest more money into non-tax or non-tax deferred kinds of accounts. But that's really not the important question. Is this graph, to me, I think doesn't answer the question that I need to know. Because I'm more interested in how much money will I get to spend when I get to retirement. So if I put this in for 30 years, both accounts will have $611,000 in it. Because I'm putting the same amounts in each one. Hopefully that makes a little bit of sense. But the more important question is, after I pull this money out, how much is taxed? In a traditional IRA, or even in a variable annuity, all the money coming out is taxed. In a Roth IRA, none of the money is taxed. So would you rather get $611 and pay taxes on withdrawal, or $611,000 and never pay taxes? So I think the Roth IRA is probably one of the greatest investment vehicles ever invented. It gives opportunity for tax-free income when you get to retirement. We have one more chapter to go where we'll talk a little bit more about retirement planning.